Well, June kept investors on their toes. Could July bring a steadier run? My next guest seeing further upside for global equities, even as risks remain on the horizon. So where are the opportunities? Let's ask Robert Talevski from Activam Group. And Robert, there's always another day, another headline. I mean, it looks like this fragile peace deal in the Middle East once again really teetering here. So more risks for investors.
Yeah, hi Juliet. Look, June was a bit of a fizzer. Markets seem to have stalled, momentum faded a little bit. July historically tends to be a solid month, and now we're going through sort of, I guess, that Q2 earnings season, which in our view we see sort of a potential for upside, a surprise, if you like, making sort of, I guess, equity markets cheaper and allowing for the PE expansion. Look, sentiment not overly bullish either, leaving room for sort of equity market expansion as well. Look, only 23% of active managers are beating their sort of large cap index, sort of, I guess, the worst in 5 years. Probably being forced to buy back on the dip as well. Look, growth managers have had sort of one of the worst 5-year stretches, adding to pressure to chase returns, which also could add to equity market returns. Look, market breadth is also improving. We're sort of sitting at around 70%, a healthy shift away from the narrow leadership we've seen in the last couple of years. And look, Mag 7 have sort of gone sideways since sort of October last year, allowing for that sort of expansion of breadth. And look, fundamentals seem pretty strong. The AI boom is sort of not feeling like a bubble just yet. And look, the Fed, unlikely to hike rates, base case probably on hold through 2026. But Fed moving away from forward guidance as well, less sort of Fed speak in terms of public market signals could also help equities.
So is it really just about timing? You know, the new month of the new financial year, July tends to do better.
Yeah, typically speaking, but again, there's sort of more of that sort of, I guess, situations where like earnings momentum, for example, should remain strong, I guess, through to this earnings season. We're expecting a sort of above 20% Q2 growth year on year. That's the second straight quarter in a row we've seen that sort of really strong earnings growth rate. Semiconductors remain sort of, I guess, secular and not cyclical at this stage. This should support higher multiples. Nvidia currently sitting around 16 times forward, and semis around 20 times forward PE. Still reasonable given sort of the long earnings cycle. S&P trading at sort of 23 times forward 1 year as well, equal weighted at 19. So I guess that sort of, again, the market breadth improvement supports upside going forward for equity markets.
All right, so when you talk about the upside driving that, you've also warned somewhat of a pullback later in the year. So what could trigger that?
Yeah, so at this stage in our view, our house view is that there's probably likely another pullback, maybe between September and November. Look, recent declines sort of felt worse than what they were, the actual size back in Feb to April, which was around that 7%. So maybe anywhere from 5 to 15%. Look, the pullback even in light of these strong fundamentals, which I guess suggested a pretty very quick sort of recovery, given obviously the fundamentals and earnings stay pretty strong. And the new Fed, I think, as well, the framework around how they're going to change, obviously announcements and going forward, and SpaceX share unlocking. These are sort of, and obviously the shortage in oil supply. These are sort of three factors in our view that may, be a source of market pullback. All
right. Well, where are the opportunities then, Robert?
Yeah, look, I think from our positions, our overweights to small caps and emerging markets. They've done really well for our portfolios. We continue to believe they'll continue to run and small caps, I mean sort of global small caps as well as overweight international versus domestic. In our view, that's something that should continue to perform well. I mean, emerging markets are up 36% for the year. I mean, that's amazing. But in our view, you may not get that same upside going forward that we've seen sort of these last 12 months as well. On the downside, we still think Aussie small caps and mid caps will probably underperform over the short to medium term.